When most investors look at a company, they fixate on one number: earnings per share. It's the headline figure in every report, the number analysts debate, and the metric traders react to. But Benjamin Graham saw it differently. He believed that true investing required us to look beyond reported earnings and uncover something far deeper, what he called a company's earnings power. Earnings power, as Graham described it, wasn't about what a company earned last quarter or even last year. It was about what it could consistently earn over the long haul, under normal business conditions, without extraordinary luck or manipulation. It represented the steady heartbeat of a business, its genuine ability to create value year after year. In a sense, earnings power is the opposite of speculation. Where the speculator sees opportunity in excitement and movement, the intelligent investor seeks consistency and substance. Graham's approach was simple but revolutionary. If you could understand and quantify a company's true earnings power, you could determine its real worth, independent of what the market said. This principle became the cornerstone of his philosophy, shaping generations of investors who followed, including Warren Buffett. But Graham's journey to this insight wasn't just intellectual. It was shaped by crisis, deception, and the failures of the financial world around him. The early 20th century was a time of rapid industrial growth and financial innovation, but also of recklessness and fraud. Many companies inflated their earnings to attract investors, painting rosy pictures while concealing weak fundamentals. When the stock market crashed in 1929, those illusions shattered and fortunes disappeared overnight. It was during this period of chaos that Graham developed his framework for analyzing a company's true earning power, not the numbers on the surface, but the story beneath them. He understood that reported earnings could lie, but economic reality could not. In this episode, I'll walk you through Graham's step-by-step process for analyzing earnings power, a method as valuable today as it was in his time. You'll see how Graham uncovered hidden truths behind company reports, how he separated genuine earning ability from financial trickery, and how his approach can still help modern investors identify real value in a world obsessed with short-term results. Because while markets evolve, the nature of value and the way to find it remains the same. But before we can begin analyzing companies as Graham did, we need to understand why he refused to take reported earnings at face value, and how one of the biggest financial scandals of his time reinforced that belief. In Graham's time, corporate financial statements were far from standardized. Companies had enormous flexibility in how they presented their numbers. Depreciation schedules, inventory valuation, and even the definition of earnings varied wildly. Some firms treated optimism as accounting policy. One famous example from Graham's era was the case of Insull Utilities, an empire built by Samuel Insull, a former assistant to Thomas Edison. Insull's companies appeared enormously profitable throughout the 1920s. On paper, earnings grew steadily, and investors rushed in, confident in the illusion of strength. But when the Great Depression hit, the entire conglomerate collapsed. The supposed profits had been little more than accounting smoke, inflated through aggressive write-ups of asset values and hidden leverage. Graham studied these failures closely. He realized that the very foundation of investing, the company's reported earnings, could be deeply misleading. As he wrote in Security Analysis, the figures are not facts, they are opinions, and sometimes bad opinions. His conclusion was simple: never accept reported earnings as truth. Instead, the intelligent investor must reconstruct reality from the raw materials of a company's financial statements. Graham approached a balance sheet and income statement not as a report to be believed, but as a mystery to be solved.
He would adjust for excessive optimism, normalize results over several years, and eliminate one-time gains that distorted the picture. His goal wasn't to find the best-case scenario, but the average case, the sustainable level of earnings a company could produce through the cycles of boom and bust. And that's a principle that still holds today. In modern times, even with stricter accounting standards, companies continue to massage numbers. Terms like adjusted EBITDA, pro forma earnings, and non-GAAP results are descendants of the same practices Graham warned against nearly a century ago. Consider the tech boom of the 2010s. Many high-growth startups reported adjusted profits, excluding costs like stock-based compensation, as if paying employees with shares didn't count as an expense. Investors, dazzled by rapid revenue growth, ignored the underlying weakness. When markets tightened, many of those firms struggled to generate any real earnings at all. Graham would have seen it coming. He understood that accounting creativity is timeless, and that the intelligent investor's job is to strip away illusion until only the true earning power remains. So how did he actually do it? How did he move from the tangled web of financial statements to a reliable estimate of sustainable earnings? Next, we'll walk through Graham's first step, reconstructing the past, and how looking at a company's earnings history, not just its present, can reveal the truth about its real earning capacity. To Graham, understanding a company's true earning power began with a simple but powerful idea. A single year's earnings mean almost nothing. The intelligent investor, he believed, must look beyond the noise of any given quarter or year and study a history, preferably a decade or more. Only by examining the record over time could one distinguish between temporary prosperity and genuine repeatable strength. In the 1930s, this approach was revolutionary. Most investors focused only on the most recent earnings report, often extrapolating it forward as if nothing could ever change. Graham knew better. He had lived through the roaring 1920s when companies like U.S. Steel and General Motors seemed unstoppable, reporting record profits year after year. Then came 1929, and those earnings, the same numbers that had justified sky-high stock prices, vanished almost overnight. From that experience, Graham learned that investors must study average earnings across a full business cycle. He recommended taking at least a 7 to 10-year period and adjusting for any abnormal years, both the exceptional highs and the crushing lows. The goal was to determine what a company could earn under normal conditions. For example, imagine analyzing a manufacturing firm in Graham's era. Suppose it earned $5 per share in 1928, $1 in 1932, and $4 by 1937. Most investors would fixate on the most recent $4 figure, assuming the company was back on track. But Graham would instead average those earnings over the entire decade, recognizing that recessions and booms are both part of reality. If the average came to $3 per share, that was the figure he trusted. Why? Because it represented the company's earning power through the economic weather, not just under sunny skies. This discipline remains as vital today as it was in Graham's time. Modern markets are still dominated by short-term thinking, investors obsessed with next quarter's EPS guidance or the latest earnings beat. But corporate history, when studied properly, reveals far more than a single earnings call ever could. Take a modern parallel, a company like Disney. Its profits may fluctuate wildly due to movie releases, streaming investments, or park closures, but when you examine earnings over a full decade, you get a much clearer view of its underlying resilience. Graham's insistence on reconstructing the past was not about nostalgia. It was about establishing context. Without context, numbers deceive. With context, they begin to tell the truth.
But even when the historical record is clear, another danger lurks, one that Graham warned investors about repeatedly: inflation and cyclical distortion. Not all earnings are created equal, especially when the value of money itself is changing. Next, we'll explore Graham's second step, normalizing earnings, and how he adjusted for the distortions of inflation, cycles, and temporary booms to uncover a company's true, enduring profit power. Once the historical record was assembled, Graham's next step was to adjust it, to normalize the data so it reflected true earning power rather than temporary conditions. To him, raw earnings were like unrefined ore, valuable, but mixed with impurities. Inflation, cyclical swings, one-time gains, or write-offs could easily distort the picture. Without adjustment, even a decade's worth of data could mislead an investor into thinking a company was stronger or weaker than it truly was. During the 1930s and 1940s, this process was essential. America was emerging from the Great Depression, then entering wartime production, and later facing post-war inflation. Corporate profits fluctuated wildly as the economic climate shifted. Graham recognized that investors needed a way to filter these distortions out, to reveal what a company could consistently earn under ordinary circumstances. He often used what he called earning power adjustments. This meant taking the average of past earnings, but also stripping out unusual items, such as asset sales, one-time tax benefits, or temporary price controls. For example, a steel company might have doubled its profits during wartime due to massive government contracts, but Graham warned that such profits were not sustainable. The intelligent investor should adjust those years downward to reflect what the company could earn in peacetime conditions. The same principle applies today. Consider a modern energy firm during an oil price surge. If profits suddenly spike due to geopolitical turmoil or temporary shortages, those gains don't necessarily represent the firm's true earning capacity. A disciplined investor, following Graham's method, would smooth out those peaks and valleys to estimate what the business might earn in a normal environment. Another key adjustment Graham made was for inflation. In his later years, particularly in the 1950s and 60s, he observed that nominal earnings often rose simply because prices had risen, not because real profitability had improved. He advised investors to be cautious. Rising dollar profits could mask declining real returns. In practical terms, Graham would look at whether a company's real earning power, its ability to generate profits after accounting for the changing purchasing power of money, was stable or improving. This concept, though simple, remains incredibly relevant in an era of fluctuating interest rates and currency shifts. Graham's method of normalization turned chaotic data into something meaningful, a reliable measure of sustainable profitability. It was a safeguard against being deceived by temporary euphoria or panic. But normalization alone was not enough. To truly understand a company's earning power, Graham believed investors had to look beyond accounting profits altogether to consider how those earnings translated into real economic strength. That required examining how the business used its profits. Next, we'll explore Graham's third step, analyzing earnings quality, and why not all profits are created equal. Some earnings strengthen a company, while others merely disguise its weakness. After adjusting for the ups and downs of economic cycles, Graham turned his attention to the heart of the matter, the quality of a company's earnings. He understood that two firms might report identical profits, yet one could be fundamentally sound, while the other teetered on the edge of trouble. To Graham, quality meant repeatability. Could the company maintain and grow those profits year after year? Were they derived from the firm's main line of business or inflated by accounting tricks, asset sales, or temporary booms?
He would say that earnings are only as dependable as the process that produces them. If profits were being driven by unsustainable forces, then the reported numbers were little more than an illusion. During the 1930s and 1940s, Graham encountered many such illusions. Some railroads, for example, reported impressive profits during short bursts of economic recovery, yet failed to maintain them when business slowed. Others boosted earnings by cutting maintenance, a short-term benefit that led to long-term deterioration of their assets. Graham viewed such tactics as red flags, signs that the company's management prioritized appearances over substance. He emphasized a simple but powerful distinction: real earnings versus accounting earnings. Real earnings came from genuine operational efficiency, strong demand, and prudent cost control. Accounting earnings, on the other hand, could be manufactured through creative depreciation schedules, aggressive revenue recognition, or failure to account for capital needs. In his teaching, Graham often highlighted companies with fat balance sheets but thin earning power. These were businesses that looked solid on paper but generated poor returns on their capital. He argued that the true measure of earning power was not the size of a company's assets, but how effectively it turned those assets into profits. We can see this principle clearly today. A modern tech company might report record quarterly profits, but if those profits depend on one-time cost cuts or stock buybacks rather than genuine business growth, the underlying earning power may be fragile. Graham would remind us to ask, are these profits sustainable without financial engineering? He also cautioned investors to examine earnings retention. A company that reinvested its profits wisely to generate future growth displayed genuine strength, but one that squandered earnings on poor acquisitions or excessive executive compensation was eroding shareholder value. In short, Graham's approach required peeling back the surface to see the engine underneath. Quality earnings are steady, transparent, and repeatable. Poor quality earnings are erratic, opaque, and easily manipulated. Once the quality of earnings was established, Graham moved to the next step, assessing whether those earnings translated into adequate returns for investors. After all, even a stable company could be a poor investment if it generated low returns relative to the price an investor paid. Next, we'll uncover how Graham connected earning power to valuation, and how he used that relationship to identify both bargains and traps. Having determined the quality and stability of a company's earnings, Graham's next step was to translate those numbers into value, the cornerstone of his philosophy. He believed that investing success depended on paying a fair, or ideally less than fair, price for a company's earning power. In Graham's framework, earnings were not just figures on a statement. They represented the business's true ability to produce wealth for its owners. To him, the question was simple but profound. How much is a dollar of earnings really worth? In the early 20th century, before the invention of advanced valuation models, Graham pioneered a rational way to answer that. He would look at the company's average earnings, say over the past 7 to 10 years, and apply a multiple that reflected the stability and predictability of those earnings. The more stable the profits, the higher the multiple one could justify. The more volatile or uncertain, the lower the multiple should be. For example, a steady utility company might reasonably trade at 15 times its average earnings, while a cyclical steel manufacturer might only deserve 8 times. This was not a rigid formula, but rather a reflection of risk and reliability, ideas that would later form the basis for modern valuation ratios like the price-to-earnings or PE multiple.
One of Graham's most insightful teachings was that investors must anchor their expectations in reality. He warned against paying inflated prices for companies simply because their earnings were growing fast. History, he noted, is filled with examples of once glorious growth stocks that disappointed their investors when growth slowed. He would often reference the boom of the 1920s, when many investors paid absurd prices for industrial companies on the assumption that prosperity would never end. When the Great Depression arrived, those expectations were shattered, and with them, fortunes were lost. Today, the same principle applies. Investors often chase hot sectors, whether tech, biotech, or renewable energy, assuming that rapid revenue growth will automatically justify high valuations. But as Graham would remind us, even the most promising business must be judged by the earnings it can sustain over time, not the dreams it inspires in the moment. His goal was to calculate what he called the company's earning power value, the worth of the business if its normalized earnings continued indefinitely. This was a conservative estimate, not based on rosy projections or wishful thinking. And if the market price was well below this conservative estimate, Graham saw it as a margin of safety, the investor's best protection against error and uncertainty. This simple yet powerful idea
bridged the gap between numbers and judgment. It required both quantitative rigor and qualitative insight, understanding not just what the company earned, but how it earned it and whether that performance could endure. In many ways, this step represented the heart of Graham's philosophy. The intelligent investor, he believed, must be both an analyst and a realist, measuring not what he hopes the market will do, but what the business itself can reliably produce. But even after this careful analysis, Graham had one more crucial filter before deciding to invest. It was the final and perhaps most vital step in evaluating a company's earning power: the margin of safety. In the next and final segment, we'll explore how Graham's margin of safety principle turns sound analysis into intelligent action, and why it remains the single most important concept in all of investing. After all the calculations, adjustments, and careful reasoning, Graham's process always led to one final question: is there enough margin of safety? To him, this was not just a technical consideration, it was the moral and intellectual foundation of investing itself. The margin of safety is the cushion between what you pay for a business and what it is truly worth. It's the difference between an investment and a speculation, between preservation of capital and potential ruin. Graham often compared it to the safety margin in engineering. A bridge built to support 10 tons is not designed to collapse at 11. It is constructed to hold 30 tons, maybe even 40 tons, so that even under stress it endures. In the same way, an investor should never buy a stock assuming everything will go perfectly. He must buy it assuming some things will go wrong. This principle was born out of Graham's own scars. During the 1929 crash, he saw years of accumulated gains evaporate within months. Companies that once looked profitable turned out to be hollow. From that devastation came his conviction that no investor is immune to error, but all can prepare for it. The margin of safety, therefore, was not about predicting the future, but protecting against it. If a stock's true value, based on normalized, high-quality earnings, was $100 per share, Graham would not buy it at $95 or even $85. He wanted a wide discount, perhaps $65 or $70. That gap represented protection against misjudgment, bad luck, or temporary market panic.
He summarized this idea beautifully. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. In today's markets, this wisdom remains just as vital. Investors often get carried away with precision, fine-tuning valuation models, adjusting growth assumptions to the decimal point. But as Graham would remind us, the future will always surprise you. Even the best companies can stumble. The most promising industries can decline, and the most confident forecasts can fail. Consider how, in recent years, once dominant businesses in retail or technology have fallen to new disruptors. Investors who demanded a margin of safety, who refused to overpay, were spared the worst losses. Those who assumed growth would continue indefinitely often learned a painful lesson. The beauty of Graham's margin of safety principle is its humility. It acknowledges that we, as investors, are fallible. We cannot predict every outcome, but we can control how much risk we take on when we act. And this principle doesn't just apply to stocks. It applies to every financial decision, from buying real estate to running a business to managing personal savings. Always leave room for error. Always plan for uncertainty. In essence, Graham's 5-step process, studying stability, normalizing performance, judging earnings quality, linking earnings to value, and insisting on a margin of safety, forms a complete philosophy. It turns investing from a gamble into a discipline, from speculation into intelligent action. When I look at today's market, crowded with algorithms, forecasts, and noise, I can't help but hear Graham's quiet voice reminding us, in the end, the investor's chief problem, and even his worst enemy, is likely to be himself.
The path of the enterprising investor isn't about finding shortcuts or secret formulas. It's about developing the patience, prudence, and clarity of thought that allow you to recognize value when others don't, and to act only when the odds are in your favor. So as you analyze companies, remember this process. Look for consistent earnings, test their quality, relate them to value, and protect yourself with a margin of safety. Do this with discipline, and you won't need to predict the market, because your principles will protect you better than any forecast ever could. That is the enduring power of Graham's method, a timeless roadmap for those who wish not just to make money, but to do so wisely.